When an entrepreneur starts a company, one of the first major challenges they face is securing funding. Before reaching the stage where institutional investors show interest, many founders turn to a more personal source of capital, what's often called friends, family, and fools, or FFF. This type of early-stage funding is informal, built on trust, and driven more by belief in the founder than by financial metrics. But how does it compare to venture capital, which is a structured and strategic approach to startup financing? Let's break it down. Imagine a founder with an exciting new idea. Before they have traction, revenue, or any proof that their business will succeed, professional investors are unlikely to take the risk. Instead, they turn to people who already trust them, friends, family members, and even acquaintances willing to make a small but meaningful bet on their vision. These early backers often invest out of personal belief, goodwill, or excitement, not because they have analyzed business fundamentals. The advantage of FFF funding is that it's typically fast, flexible, and far less demanding than traditional investment. There are usually no complex negotiations, no board seats, and no investor oversight, just capital to help the founder get started. In many cases, this money comes with minimal expectations of immediate returns, allowing the startup to validate its idea without external pressure. But there's a downside. Taking money from close personal relationships can be emotionally charged. If the business fails, like many early startups do, it can strain friendships, create family tensions, and lead to uncomfortable situations. Unlike professional investors who understand risk and diversify their portfolios, FFF investors are often putting in money they can't afford to lose. That's where the fools part of FFF comes in, not because they are unintelligent, but because they take uninformed risks without the level of diligence that professional investors would require. Now, let's contrast that with venture capital. Unlike FFF, which is driven by emotion and personal trust, VC is a formal and highly structured investment process. Venture capitalists are professional investors who manage large sums of money on behalf of institutional backers, pension funds, and high-net-worth individuals. They don't invest because they personally believe in the founder's vision. They invest because they see an opportunity for substantial financial returns. Before VCs commit capital, they conduct extensive due diligence, analyzing market potential, competition, financials, and the strength of the founding team. They take a long-term, data-driven approach, expecting high growth and a clear exit strategy. In exchange for their investment, they receive equity, board influence, and a say in major company decisions. While venture capital provides much larger funding rounds than FFF, it also comes with greater expectations. Unlike friends and family who may be patient with slow progress, VCs expect rapid scaling, market domination, and a return on their investment within a specific timeframe. They are deeply involved in decision-making and may push the company toward aggressive expansion, acquisitions, or even pivoting to maximize success. So, which is better, FFF or VC? The answer depends on the stage of the company. Many successful startups start with FFF funding to get off the ground, using that capital to develop an MVP, gain early traction, and build proof of concept. Once they've demonstrated potential, they can attract venture capital to scale the business to new heights. But founders must be careful when taking money from personal connections. The emotional stakes can be high, and there's often no way to recover lost funds if the business doesn't work out. That's why FFF should only involve investors who understand the risks and are willing to lose their money without repercussions. On the other hand, VC is best suited for startups that have already validated their business model and are ready to scale. While it comes with stricter terms and greater oversight, it also provides access to mentorship, networks, and strategic partnerships that FFF investors simply can't offer. In the end, both FFF and VC serve different purposes in the startup journey. The first one is about belief, support, and taking a personal bet on the founder. The second other is about structured investment, scalability, and high-stakes growth. Smart founders understand the differences and use both wisely most of the time, starting with FFF to validate their ideas and then move to VC to turn them into industry-changing companies. FFF funding is informal and emotion-driven. Friends, family, and fools provide early-stage funding based on trust and belief in the founder, with minimal financial scrutiny or expectations. It is quick and flexible, but can create personal tensions if the business fails. VC is structured and performance-driven. Venture capitalists invest based on due diligence, market potential, and a clear exit strategy. Unlike FFF, VC funding comes with strict oversight, expectations of rapid scaling, and a focus on financial returns. Both play a role in startup growth. FFF helps founders validate their idea with minimal pressure, while VC is crucial for scaling. Smart founders leverage both, starting with FFF to gain traction and securing VC when the business is ready for aggressive expansion.